Hello and welcome to Options in Plain English Advanced Edition. In this lesson, we're going to talk about a couple option strategies that are indifferent to the price of the underlying. We're going to be talking about box spreads. Box spreads are made up of a synthetic long position with options at one strike and a synthetic short position with options at another strike, with the difference between strikes being the value of the box. Box spreads values depend primarily on factors that are not related to the price of the underlying, such as dividends and interest rates. They're often used as a mechanism to lend funds to the marketplace in exchange for interest income in the case of a long box spread, or as a way to borrow funds from the marketplace at market rates in the case of a short box spread. Together with conversions and reversals as well as jelly rolls, they belong to a series of strategies known collectively as locks, since their value at expiration is locked from inception and only depends on the dividends and interest rates of their components. We'll also analyze potential risks particular to box spreads, and we'll see what we'll need to look out for when a strategy's profile seems too good to be true, and the dangers that may be lurking beneath the surface. So we're going to start talking about box spreads, and the first thing we're going to do is we're going to talk about put-call parity. And we're not going to talk about put-call parity a lot, we're just going to take the formula, but if you want to know more about put-call parity, you're welcome to look for this video, for a video on put-call parity on my channel, and you can find a lot more information about put-call parity there. In here, we're just going to talk about the formula for put-call parity, and in this case, we're interested in the formula for a long stock, where we say here that long stock is equal to a long call and a short put at the same strike price, and the income from dividends added to it minus the income derived from interest rates subtracted from it. So basically, this is the put-call parity formula, where we can create a long stock by using a long call and a short put at the same strike price. If we assume that there's no dividends, and we also assume that there is an interest rate of 0, what we're going to have a very simple formula, and yet very powerful, which says that a long stock position can be replicated with a long call position plus a short put position at the same strike price. So basically, if you want to talk about it visually, you would have a long call, which is the position that we already know, which has a unlimited profitability and limited risk, and a short put at the same strike price. So here, just imagine that you put them both together, and you're going to create a new type of position, and this position is going to be a long synthetic position. So what this means is it's not stock, it's a synthetic version of a stock but with options. So if you put together a long call and a short put at the same strike price, what you have is going to behave as if it was a long stock position. And especially if we ignore dividends and interest rates, is going to be very, very close to the way a long stock position would behave. Now, if we analyze put-call parity in a very similar way, but for a short stock, what we're going to have is a very similar formula, but we're just going to have to change all the signs, and that's going to be it. Basically, a short stock position is going to be replicated, or could be replicated, by having a short called position and a long put position, and then subtracting the income from dividends, and then adding the income from interest rates. So if we assume that there's no dividends and that the interest rates are 0, this formula is going to be simplified, and we're going to have a very similar formula, but with all the signs changed. So basically, short stock is equal to short call and long put at the same strike price. So if we think about it this way, we can replicate a short stock position with options. So we have a short call at a certain strike price, And then at the same strike price, you're going to have a long put. So if you think about it, the short call, it's a position that we already know. It's a position that has unlimited risk and limited profitability. And a long put is a position that has limited risk and almost kind of unlimited profitability, and at least all the way down to the underlying getting down to zero. So we could say that it's unlimited profitability. So short call and long put is going to be the same as short synthetic. So it's going to be the same as short stock, but with options. So it's called a synthetic version of stock with options. It's called short synthetic. So out of all this, what we need to know is that you can replicate a long stock position with options by having long call and short put at the same strike price, especially if we have no dividends and no interest rates. And we can replicate a short stock position, which we will call a short synthetic position, and synthetic stock, basically short stock, a synthetic version of short stock, can be replicated by having a short call and a long put. Okay, so now that we know all this information, if we think about an example or a position that we can imagine where we have a long synthetic position, basically we have long call, short put, same strike price. So you're long at this strike price. And then you have a synthetic version of short stock at a different strike price, at a higher strike price. You're going to have a long put, you're going to have a short call at this strike price. And just for the sake of clarity, we can call them KL to the low strike price and KU to the upper part of the range. So to the higher strike price, we're going to call it KU. And we think about what would the result of these two synthetic versions of stocks, so long stock and short stock, what would be the result of putting them both together? So if you can imagine these two values being added at every point in the price of the underlying, okay, and you're gonna need to extend this short synthetic line all the way to the left, and this blue synthetic, long synthetic line all the way to the right. If you can imagine that, and you add both points at every point on the underlying price axis, then you can pretty much figure out that being long at this price and then being short at this price simultaneously, what you're going to have is you're buying at this price, you're buying at KL, and you're selling at KU. So you're going to have a profit equal to KU minus KL at every point in the whole range of underlying prices, which is what we have. So this line represents the value of this whole position, so which would be a different configuration, because it would be long synthetic at this strike price and then short synthetic at this strike price. Okay, so what value is this whole position going to have at every price of the underlying? The value is going to be KU minus KL, the difference between strike prices. So if you think about it, this is a position that's going to have a value at expiration of KU minus KL. So it's something you can buy, and you know that it's going to have this price at expiration. So the first thing you can think of is, if I can get it at a discount, then I can make some money, and it's going to be for sure, because it doesn't matter what the underlying price is at expiration. It's always going to have the value of KU minus KL. Okay, so this whole configuration, this long call short put at this strike price and long put short call at this strike price, is called a long box spread, which basically means that you're long at a certain strike price, KL, and then you're short, synthetic version of a stock, at the strike price KU. Okay? So if we analyze it, we have that in this example, we have a box spread, a long box spread that's at the money, but it doesn't need to be. The at the money could be here, and then all the components could be below the at the money price, or they could be above. You could have the at the money over here, and all four components could be at higher strike prices. So if you put all these components together, you're going to have a line very similar to this. So the profit and loss, let's say, for example, let's think of an example so that we can think about what this value could be. Let's say that we have a strike price KL is 90, and let's say that KU is 100. So in this case, this line is going to be a constant line at 10. It's always going to be 10. So if you go to the market and it's selling for $10, well, you can buy your box at $10, wait until expiration, and then get $10 back. You're not going to get any profit or loss. Of course, I'm ignoring slippage and the commissions and transaction fees. But in terms of the profit and loss of the position itself, we're talking about not having a profit and not having a loss because you bought it at the same price that it's going to expire at. So what would happen if, for example, we have this condition where we can initiate it for a debit? So we buy the box spread under par, which means we're going to have a situation where basically what this formula says is that the whole credit, so CL minus PL plus PU minus CU, so basically the whole price that we're going to pay to get the box, if it's less than the difference between strikes, then you just buy it and you can close it for par, so KU minus KL. So you just buy it and then you wait and then you collect your profit. So if you go to the market and this is $10, it's a constant $10. So it's $10 and you buy it for $9.50. Well, then you're going to have 50 cents, but you're going to have to wait until expiration. So in a way, it's a little bit like lending money to the marketplace, which is what a box spread is considered. You pay $9.50, you can't use them because you have to keep that money for this position, and then you wait, and at expiration you will collect $10 and you have 50 cents in profits. Okay, so this is a long box spread. If you buy it under par, so if you buy it for less than the value and you wait, that's why you have a little bit of a dash line here, because if you buy it under par, then you're going to have a profit at the end of the day when it expires. So now we're going to do the other side, and the other side is we have a short synthetic version of stock here, so long put, short call at the same strike price, and then we have a long synthetic version of stock, so long call, short put at a higher strike price. So we're going to have something that's very similar to what we had before, but in this case, I'm shorting at the lower strike price, and I'm basically buying at a higher strike price. Okay, so what's going to be the value of this configuration at any point in the underlying price range? Well, the value is going to be, of course, a negative price, because as you can see here, if you mentally, or you can imagine this line extending all the way down to here, and then you put these two together, it's always going to be a pretty much a horizontal line. So it's going to be a constant line, and it's always going to have this value, and this value is going to be KL minus KU. So it's going to be a negative value, meaning that it's not something that has value and you can buy. It's something that has negative value. So if you buy it, you actually get the money. So you can initiate this position for a credit, and then you need to close it for a debit, and the debit at expiration is going to be KL minus KU, so the difference between strike prices. Okay, so it's the opposite, is the mirror image of a long box spread. In this case, this position is called a short box spread. So when you open it, you get money, and then you are committed to paying it back to closing this position that you have, and you have to pay. You're gonna have to pay for it at expiration. Okay. So let's say that you have the same example. You have 90 here and $100 here. So if you go and you do a short box spread, you're going to collect the difference between strikes. So you're going to collect $10. So if you go to the market, it's probably not going to be trading at $10, but it's going to be $10 at expiration. So if you can get $10.20, okay, and then you get the short box spread, so you sell the box, you get $10.20. At expiration, you're going to need to close it for $10, so you can keep the 20 cents as profit. So this is how it works. A box is just a position that doesn't depend on the underlying price, but it depends on its internal components, which is what we're going to talk about in just a little bit. Okay, so if you can hold all the components to expiration, you know that for sure the value at expiration is going to be the difference between strike prices. Okay, so you can buy this. So you put money, you bring money into the market, and you buy a box, and you wait until expiration, and it expands or contracts depending on the initial price to the value that would be the difference between strike prices. So you buy something at $9.50, for example, and at expiration is going to be $10. You make 50 cents. In the case of a short box spread, it's the same thing, just in reverse order. You first sell and you get a certain price, whatever is trading at in the market, and then at expiration, you can just close it by paying the difference between strike prices. So if you can get $10.20 and you can close it for $10, then you can keep your 20 cents as profit. Okay, so this is how it works. There is no max profit is locked. There is no max loss is locked because it doesn't depend on the underlying price. These positions, boxes, conversions, reversals, jelly rolls, all those positions are called locks. And the reason why they're called locks is because they don't fluctuate. They only fluctuate based on external components, so dividends, interest rates, but not because of the underlying price. They're indifferent to the underlying price. It's always a constant value. Okay, so this is what it means to have a box. A long box, you can buy it. A short box, you sell it and you get the credit, but you're committed to at some point closing it and coming up with the money to close it, and it would be the difference between strikes at expiration. Okay, so let's analyze boxes or box spreads and see what we can get in terms of information about box spreads. Buying a box spread lends money to the market, which is what we're talking about. You buy a box, you pay for it, and you wait, and then you hope that if you bought it for less money than it's worth, that it's going to expand, and at expiration is going to be worth, of course, the difference between strike prices. Now, you could close it before expiration if there's some favorable pricing in the components. And you could do that, of course, but usually the point at which the value is going to be exactly the difference between strike prices it's only at expiration, because there's no more extrinsic value in any of the components. So buying a box means lending money to the market. Selling a box borrows money from the market, which is the opposite. You go to the market, get the money, use it, put it to work, whatever. At expiration, you need to bring it back, and you're going to pay, for the most part, you're going to be paying some interest for it based on the interest rates in the market. Box spreads will have a value at expiration equal to the difference between strike prices. Okay, in this case, KU minus KL, or KL minus KU. If you can buy a box for less than notional or sell a box for more than notional, there is potential for an arbitrage play. However, you need to factor in all the risks related to holding a box until expiration. So once you have these components, and let's say, for example, these are American style options. So those are subject, especially the ones that you're long, you control the exercise. But the ones that you're short, so for example here, a short put here in this short call, and in this case, this short call and this short put, these are components whose exercise you don't control. You can only get assigned. So this is a risk, because if you get assigned early, then you can't wait until expiration. Now your whole position is a mess, because now you have, if you get assigned on a short call, then now you got short stock, and then now you have to exercise the long call that you have at a higher strike price, and then materialize the loss that you have here, and then you need to reestablish it, and it's a mess. So this is a risk. This is a known risk with boxes. Okay, so it's a risk, and they're primarily very risky if you use American style options. If you use an index, which is European style, or some futures, which are European style, some of them are American, but let's talk about the ones that are European. You can have a box and you can't be assigned early. You can't exercise early, so you can just buy it, hold it, and then at expiration you cash out. And but for American style options, you have that risk. The risks, these are primarily dividends and interest rates as potential triggers for early exercise in American style options. A very important indicator of heightened early exercise risk for American style options is a low extrinsic value on a short option. So anytime you're short an option that has almost no extrinsic value, the extrinsic value is like a gate. It's like a gate that you have in front of your house, and that prevents you from being assigned, because the buyer of the option is going to sacrifice that extrinsic value. So if that extrinsic value is significant, they're not going to exercise. But if this extrinsic value is very low and very little, the probabilities that they're going to exercise, since the cost is going to be so little, go higher. Okay, so any option, this is not only for box spreads, but any option that you have and that you're holding and that is short, that has very little extrinsic value, and that is in the money, of course, is at risk for early exercise if we're talking about American style options. If we're talking about European style options, then there is no risk, of course, because those are only exercised at expiration. So in summary, a box spread is a position that's made up of a long synthetic and short synthetic, which means long call, short put at a certain strike price, and long put, short call at a different strike price. If the one you buy is the lower strike price, then it's a long box, and if the one you sell is the lower strike price, then that's a short box. With a long box, you go and buy it, you bring money and you buy it and you hold it, and then at expiration you cash out and you sell it for whatever it's worth, and it's going to be worth the difference between strike prices. In the case of a short box, you go to the market, you initiate a short box, you get the money, you get the credit, and then you need to hold it until expiration, at which point is going to be equal, the value is going to be equal to the difference between strike prices. Now, in terms of buying power reduction, we're talking about regular rules. There is no special rules. It's you can look at it as a synthetic. This is another way to look at it. You can look at this as a synthetic short, synthetic long. synthetic long, synthetic short, okay? Or you can look at this as well as a long call spread and a long put spread. And this one would be a short call spread and a short put spread, okay? So if you look at it that way, then your margin on the individual spreads, in this case, two debit spreads, in this case, two credit spreads, and the regular margining rules apply. That's what a box spread is. And now what we're going to do is we're going to quickly go and we're going to go to the platform, and we're just going to take a look at a quick, we're going to put together, we're going to try to see what the price is for a few box spreads. So we're going to see how we can put it together. Now the platform we're going to use is Thinkorswim, and Thinkorswim doesn't have the boxes as a predefined strategy, so it's going to show up as an iron condor or something like that. We're gonna take a look, and I just want you to see the pricing and how boxes are usually priced very accurately in the market. So we're here in the platform now, and what we're going to do is we're going to be taking a look at spiders. So this is the ETF for the S&P 500, SPY is the ticker symbol. And what we're going to do is we're going to open up the 21st of August 2020 expiration. So this one has 39 days to go, 39 days to expiration. And we're just going to randomly, I'm just going to initiate I'm going to buy a box spread and see what the pricing is right now. So if I could buy a box spread, and I'm going to see what they're going for right now. So the price, like I said, is indifferent, doesn't matter. So I'm just going to buy the let's say the 316 is 317.59. So I'm going to buy the 316 321 box. Okay, so I need to buy the call. So what I'm going to do is I'm going to pick the individual components. So what I'm doing right now, for those who have access to Thinkorswim but don't know what I'm doing because I'm not showing it, I'm holding my control button so that all these components keep adding up. So they're being added up to a single trade. Okay, so I'm hitting the control button on my computer so that I can start adding the components. So I'm going to buy the 316 call and sell the 316 put. Okay, so buy, and I'm going to sell the 316 put, and now I'm going to go to the 321. In this case, I'm going to do the opposite. I'm going to sell the 321 call, okay, and I'm going to buy the 321 put. Okay, so now we have the trade here, and you can see it shows as an iron condor here with these components, and for the expiration. And this is the if you look at this, the call is the 316 call long, 316 put short. So this is our long synthetic component. The 321, we have the short call, and we also have the long put. So we have the opposite. We have the a short synthetic, and it's trading exactly for $5 because that's what the box is going for in the market. So if I buy it and I wait, and then at expiration is going to be worth $5, so I made no money. So I'm not doing anything here with this trade. So let's go to, this was a long box spread. So now we're gonna take a look at a different ticker symbol. I'm going to just think of one. Let's say Intel. Okay, it's quite liquid, and see if we can take a look at this one. Okay, so Intel is trading at 59.53, but the price doesn't really matter. So what I'm going to do now is I'm going to sell a box spread. So I'm going to get money up front, and then I'm committed to closing it at some point in time prior to expiration or at expiration. Okay, so I'm going to be selling my synthetic, so which means I'm going to be selling the call, Again, I'm holding the control button on my keyboard. So I'm selling the call and I'm going to buy the put. Okay. And then I'm going, this is the 50, I'm going to do the 50-60, okay, or the 50-65. So a $15 wide box. Okay, it's 50, I have that component. So the 65 is going to be my long portion. So I'm going to have the long call and the short put, okay? All right, so if I go to the pricing here, we have, again, it's showing up as an iron condor, it doesn't matter. So at 50, I have short call, long put. So I'm short synthetic stock. And then at 65, I am long a call and I'm short a put. So this is synthetic long stock, okay? So this one is trading for $15.28. So in theory, you would think, first of all, the liquidity is not as good as the other one. Okay, so this is the mid price. The natural is trading at $14.55. So it's unlikely that I'm going to get filled here. But again, as we were mentioning before, we need to be careful here because once we have, for example, in this case, we have the short 50 call, and this stock, Intel, pays a dividend. Okay, so if it pays a dividend, then my short call is going to be at risk of early exercise. So this box, this short box, even though you might think, okay, I'm going to get 28 cents for free, well, you have to really take a deep dive into the numbers to see whether your call is going to be at risk for early exercise, and whether that's going to affect the pricing of all the components once the dividend is paid out. I mean, you would need to check the dividend date, whether it affects you or not. There's many things that need to be checked, but as you can see here, this box is trading at 15.28. You can put it on and then wait, and if you survive and you have all these components and they're not assigned or you don't exercise them, then at expiration this thing is going to be worth $15 and you can keep the 28 cents. This is how it works. This is a pretty much an arbitrage play. So it's basically if you can weather the storm and keep all the components here all the way until expiration, you're going to have 28 cents here. Now, again, we're talking about a stock that pays out a dividend, so we need to be careful there. We're also talking about not a very liquid stock. So what I'm going to do now is I'm going to finally, and this is going to be the last thing we're going to do, I'm going to be analyzing an index. I'm going to go to SPX. Okay. Okay, SPX, 21st of August. Okay, so what I'm going to do is, now that it's SPX, of course, it's an index. It's European, pays no dividend, of course, because it's an index. You can't be assigned, you can't exercise it, so it's cleaner. It's a cleaner product. So what am I going to do? I'm going to buy a box, and I'm going to buy the 3180, 3200, and see what price I get. Okay, so 3180, I'm going to buy the call, sell the put, and then I'm going to sell the call for the 3200, and then I'm going to buy the put. Okay, so this box, which is the 3180 3200 box, is trading for $20, exactly the price that you would get if you hold it until expiration. So now you know how you can go to the platform and you can price your boxes. Now you need to be careful because sometimes there are some risks that are not apparent and that where you think that you have some free money that's there just there for the taking, and that's not the case. There are some risks associated with boxes, and what we're gonna do now is we're gonna take a look at a real life trade at a situation that got really famous or infamous, however you want to call it, that involves actually a Reddit user that had a box spread on, and it went terrible. So we're going to analyze it, we're going to dissect it, and we're going to see where the dangers were prior to this trade going horribly wrong. So now we're going to go there, and we're going to see, we're going to analyze it, and it's going to be a very good exercise, and we're going to see what really happened. So now we're back, and what we're going to do is we're going to be taking a look at the legend of IRONYMAN, I guess, or 1RONYMAN. So I guess it's IRONYMAN, so that's what I'm going to call him. So he, I guess it's he, is I don't know, a Reddit user who put on a very famous trade, and if you Google him up, you're going to get a lot of results and a lot of details about this trade. Basically, what happened was he put on a short box spread, and something went terribly wrong. And we're going to dissect. We're not gonna make fun of him or anything, or maybe a little bit, but we're going to see technically, in terms of options, what happened so that it doesn't happen to us. Okay, so it all started when this fine gentleman put on this trade, and he actually made it public before it blew up. Okay, so what we have here is what he put on was, and by the look of the interface, you can pretty much figure out who this guy's broker was. But anyway, see, what we have here is, first of all, the stock is UVXY, so it's an ETF, it's a volatility ETF, and what we have here is, what he did was he did a short box spread, so he got credit up front, and now he had a position that he was committed to at some point between now and expiration to closing this position. So he had to close it before he could realize his profits. Okay, so we can see here is UVXY. Okay, so we have the 10 and the 15. So the box is the 10-15 box. Okay, the 10, we are short a call and long a put. So this is short synthetic stock. And then at 15, we have long a call and short puts. So he's basically short at 10 and long at 15. And for that, he got some credit up front. The value of whatever he could get in the market, but the position now is a short box, which is going to, at expiration, have a value of the difference between strike prices. So right now, one of the things we can see is that this says right here 2,000 contracts. In reality, it's 500 boxes, but because it's 4 components, it's 2,000 contracts, but it's 500 boxes. And he did this for, well, we're gonna analyze it. Let's just continue with the analysis of the trade. So basically, what he did was he sold a box. So he did a short box spread, and that's the 10-15 box. Okay, that's all we know so far. We're going to do a deeper dive in just a second. So let's dissect this position. We have 500 contracts. Is the 10-15 short box spread. The trade date was the 10th of January of 2019. The expiration date was the 15th of January 2021. So this trade is going to be on for 736 days until it expires. Okay, so it's quite a long-term trade. Okay, so it's 2 years. The stock is UVXY, which is an ETF, American style. So early exercise is possible. It's got no dividends. The trader legged into these positions. So this was not a position where everything was put on at the same time. So he legged into this. Every box spread in total, once you analyze the number, every box spread, and there's 500 of them, was sold for $5.75 per contract. So this box or these boxes have a notional value of $5, which is the difference between strike prices. So he was able to sell this position 500 times for $5.75. So he sold it for 75 cents above the notional value of the box. Okay, the notional value of the box at expiration will be $5 per contract. So it appears that there's 75 cents to make risk-free 500 times, so 50,000 shares. So 50,000 times 75 cents would be $37,500 for waiting pretty much 2 years. So he we're gonna talk about the margin that he needed, but basically holding this position for 2 years, you can go and collect $37,500. Okay. Now this trade, I don't want to spoil it for you, and if you haven't Googled it, I'm gonna just mention some famous last words, and I had to make it PG, so it's not literal, but it's something like it literally cannot go belly up. So he was certain, he was sure that it was just a matter of waiting, and he was gonna collect this money. Okay, and I'll tell you something: if for some reason someone could assure him that he was going to be able to hold the position until expiration, then he was actually right. If you hold until to expiration, this is going to expire at a value of $5, so you can make 75 cents per contract. Okay, and 5 days later, there was some let's just say puzzlement and bewilderment and altogether surprise reaction to what happened. Okay, 5 days later. So we're going to, it's risk-free money, it's not risk-free money, and this is what happened 5 days later. The reaction is one of surprise above everything. Okay, so let's continue. So what do we have? Let's analyze the position. Okay, so we have UVXY. I went back and I got the price that it was trading at. Of course, I don't know the time, but it was trading in around this range, and $66 seems like the right price based on the prices. Okay, so this is a trade. He's short call at 10, long a put at 10, and then long call at 15, and short a put at 403 at $15. So this is the strike price. Okay, and the actual stock is trading at $66. So right away, one of the things you can notice is that this is way very deep in the money for calls. For puts is fine because it's way out of the money. Okay, so this is fine, but for calls is really in the money, which means liquidity is not that great. It's not so easy to trade in and out of positions when you're so deep in the money. Okay, so let's continue. So this is the position that he had. So right away we can see that the extrinsic value in the short call was 25 cents. Okay, so from 66, it was trading the 10 at 56.25. So the extrinsic value was only 25 cents. The extrinsic value for the 15 strike price, the call was 51.65. So if you if you do the calculations, you'll see that the long portion had 65 cents of extrinsic, and the puts were fine. They were both out of the money, so what you see there is the whole thing is extrinsic value. He probably legged in as the stock was probably going higher, so that the puts appear to have been traded before the calls because they have a very substantial price. Okay, so this is he legged into this position, and we don't care when he legged into it. We just know that that's what he has right now. Okay, and he's got 500 of these. Okay, so 500 contracts. Okay, so right away, one of the things we notice, extrinsic is higher in the puts since they were legged into prior to the calls when the stock was on an upswing. Okay, so it was going higher, and because it was going higher, as it was as if you put on your puts, if you in this case buy this one and sell this one, and it's not that high, so they were the first ones before it went even higher, then it's going to be closer to at the money, and then the extrinsic is going to be significant. These ones, if they were traded into later, they're going to be very far from the at the money, so the extrinsic is going to be very little, which is what we're seeing here. Okay, so it appears that the extrinsic is lower in the call since they were legged into after the puts when the stock was on an upswing, and since they're deep in the money, they are at risk of early exercise, and it's kind of like a foreboding kind of thing. So I don't want to spoil it, but you see where we're going. So let's analyze this. So one of the ways we can analyze this is we got two ways. We can analyze it vertically and horizontally. So in this case, we can take both calls and we can say that the calls, this is the same position, but if I look at only the calls, I can say that this trade is short the 10-15 call spread for 460, and then this is also short the 15-10 put spread for 115. So he got altogether, both are credits, so he got 575 altogether for the short 10-15 box spread. Okay, so this is a short put spread, okay, that's trading at 115, and this is a short in the money 10-15 call spread. So if time keeps passing and it expires, this thing is going to go all the way to $5. And if it expires right here, this whole credit is going to disappear because it's way out of the money. Okay, and that's what he was banking on to make his money. Okay, another way to analyze this same position is, instead of vertically, we're going to analyze it horizontally. Okay, so what we have here is, if we look at the same strike price, then you have shorter call, longer put, then I'm pretty much short the stock at 10 for a credit of 53.37. Okay, and then I'm longer call, shorter put, so this is long stock at 15 for a debit of 47.62. Altogether, I am this position is on for a credit of 575 for the short 10-15 box spread, which is what we know, and it's the same number. So it doesn't matter how you analyze it. This is vertically just by looking at the same components, all calls and all puts, and you can get this analysis, or you can look at it by strike price and look at it horizontally here, and you come to the same conclusion. In this case, you have short stock at 10 and long stock at 15. Okay, so our trader put on a short box spread, and we're going to analyze it a little bit more, but you put it on, you collect 575 500 times, and he was intending to wait for 2 years until they expired, at which point they would be worth $5, and just keep the rest as profit. So we can continue analyzing here. We have UVXY. Okay, so we have the strike price 10.15. This is the same scenario. Okay, the only thing I'm adding here is a little bit more information. The size is 500 contracts. Okay, the box value is going to be 500 times 500 because that's the value of each box, $5. Okay, so $5 times 100 times 500 contracts, so a total of 250K. The total credit that he got was 500 times 575, so he got 287,500. Okay, so the profit would be 37.5K in 736 days. The buying power reduction is going to be for 500 credit spreads. Okay, one credit spread is going to use 500 because that's the max loss. Okay, 500 of them are going to use 500 times 500, so 250,000. In this case, he collected 287,500, so he doesn't need any additional capital. The credit is more than the value of the buying power that he needs, so this trade is fine. It's not going to be in a margin call. Okay, so the buying power reduction is going to be 250K, and he got 287.5K, which means that he's fine. Okay, so if he waits and nothing happens, then just collect the $37,500, no problem. Okay, and you might be wondering why you have 500 on this side and 500 on this side. Why are you only margined on one? Well, the stock cannot end up expired, making both spreads losers. So it's either, if it stays here, then the calls lose, and if it goes completely under 10, then the puts lose, and if it's in between, both lose, but they don't both lose the whole amount. So basically, you can lose on both sides. Because of this, you're only margined on one side, so 500 contracts, because you have 500 here and 500 here. Okay, so here's where it starts getting really interesting. 1RONYMAN got assigned on 283 contracts of his 500 short 10 strike call. So these ones we said, and actually everybody told him, if you look at the whole history of this trade, these 10 strike calls, the ones that he was short, he was assigned on 283 contracts. So right away, 1 day later, he was assigned on 283 contracts. So he's got 500 altogether. So on 283 he was assigned. Okay, so he's gonna be short 28,300 shares at $10. His broker, because now you need a lot of cash, right, to cover the 28,300, and of course our hero didn't have enough cash to cover this. Actually, he started with 5K, so $5,000. So anyways, you need 28,300 shares because you were assigned on 283 contracts that were sold short. So his broker exercised 283. So okay, you're not going to you're going to be short the stock, that many shares, but you can cover them. So you can just exercise, because this one is in the money. You can just exercise the 15, just the 283 contracts, so that we can sell them at, actually buy them at 15. So you're going to sell at 10 and buy at 15. So now he has 217 short box spreads, okay, because 283 are gone on the call side. So out of the 500 here, 283 are gone. We have 217 remaining. So we have 200, and on the put side we have 500. So 217 are balanced, are on both sides, and 283 are additional short put spreads. So now the whole thing is not in balance, because now you lost 283 boxes right here because you were assigned and then exercised. Okay. So now his position is directional or bullish because you got many more put spreads than call spreads. Okay, and they're short put spreads. Okay, so this one is the one that got assigned, and this is the one that got exercised to save his derriere, so to speak. So this is more or less a transaction. So when he was the original position, so basically as a result of the exercise and assignment, he's gonna sell 28,300 at $10 and buy at $15. So he's gonna lose money. Okay, but remember, for those 283, he sold the calls that brought a lot more money than he paid for. Okay, so yes, he lost 141,500 here and then 130,000 here. So altogether, on the 283, it's actually not catastrophic if you think about it, because he only lost $11,000. Remember, 287,500 went into his account as a result of selling the box spread. Okay, so we're still fine. This is not a problem. The problem is that now he is directional, because now there's 283 of those contracts are gone here. So you only have 217 here, and you have 500 over here. So you have 217 boxes and 283 additional short put spreads. So you're way directional. So now you're exposed to the market. You're no longer delta neutral. Now the price of the underlying really matters. Okay? So this is what we're talking about. Now on the cost side, we have 217 contracts because 283 are gone. And on the put side, we have all 500. So we have 217 short box spreads instead of 500. And 283 additional short put spreads. Okay, so now this position is bullish. Okay, directionally bullish. And here we have, let's take a look at what happened as the trades were happening. So this is when he opened the trade. This is January 10th. Okay, and then this is what happened to UVXY. Okay. I got it from the history, from the chart. And then he was assigned on 283 short calls, and the broker exercised 283 of the long calls to cover this position. Next day, it didn't even take a day. Why? Because this one only had 25 cents or so in extrinsic value. It's very little. You're at risk of being exercised, of being assigned rather, of someone exercising and you being assigned as a call seller. Okay, and on this day the account was closed. Okay, don't pay attention to the loss. Now just think about this. We mentioned this. We opened the trade, 283 are taken from us. Okay, so now we have a directionally bullish position, and the stock keeps falling down. Okay. So at this point, his account, because now those put spreads go up in value. So the box spread is fine. That's not going to move. But the short put spreads, because the price kept falling down, then the put spreads went up in value, bringing losses. And now we got to the point where the losses were so heavy, because now we're talking about here, it looks like it's trading at like $58 or so. So it's quite a bit. If you're doing size, and he was doing 283, so 28,300 short put spreads. Okay. So in such a large size, any move is going to bring a lot of losses. Now, he used to be 37,500 above the requirements, but then he lost 11,000 because of the exercise, which it's fine. You can survive that, but he couldn't survive this becoming bullish and then suffering through the drop in price. That's what killed him, metaphorically. So this is what happened to the trade. Once those were assigned and exercised, and once these contracts, this trade became bullish, now you are exposed to the market. Now kept going down, so you lose, and it spiraled out of control. And now he lost $58,000 when he had an account with $5,000. So now he owed the his broker, $58,000. Okay, so this is the loss, and this is something he posted. So basically he lost 1,800% of his account. So let's wrap it up. Takeaways: box spreads are not risk-free money, especially with American style options. Boxes are rather a mechanism to lend to and borrow from the marketplace at the prevailing market interest rates. So, in other words, it's good to know what boxes are. For us as retail traders, it's probably not going to be a source of profitable trades. If you are ever managing quite a hefty amount of capital and you need to put it to work, and you don't want to buy any product, any interest-bearing product, what you can do is you can buy a few box spreads and just hold them till expiration. But you got to make sure that if they're American style, that you know exactly what you're doing, so that the position is not destroyed by some early exercise, or you can do it with indices, in which case they're mostly European, which would eliminate the risk. So this is basically what happened to the legend of 1RONYMAN, or 1RONYMAN, however you say it. And this is what happens with box spreads. Now we know what box spreads are. We know that we're probably not gonna be opening and selling and buying box spreads. As a retail trader, it's very difficult to make money on them because of liquidity, because you need a lot of size, etc. But now you know the concept behind box spreads, and this same concept is used when you want to analyze, for example, the fact that a long put spread is the same as a short call spread, for example. Okay, if you use the same strikes. So if you know what a box is, you just apply it, and you'll know that those two positions, a long put spread and a short call spread, if you use the same strike prices, is the same position. Simply by adding a box spread, you would know that those two positions are equivalent. So it is important knowledge, and it's a good way to start thinking about positions, not only in a way of what you're seeing, but what they could be if we replace calls with puts with calls, and by knowing this, it's going to be a very interesting and a very useful tool, because at that point you're going to be able to, if there's no liquidity on the calls, for example, or they became really deep in the money and now you can't get out, then you just go to the put side and you do the exact same trade but with puts. And knowing this is going to make you a better, more efficient trader, and is going to make you have adaptability to the current conditions, whatever they might be. Thank you very much for your attention, and goodbye.